Okay, so let's get started. Well, happy Friday to all of you guys. Good to see you all here. This is going to be a brief overview on the cryptocurrency market, quite a high level overview. We'll go into some details about Bitcoin and Ethereum, of course, the key markets. Look at some fundamental factors at play at the moment, why markets are moving. Then we'll look at a smaller altcoin, which might be of interest to some of you. And then finally, we'll look at blockchain activity on the blockchain. So what data we can get from the blockchain and how we might be able to use that in trading. Good. So first, you should be able to see a screen of Btc Market Cap. So this is the dominance of Bitcoin versus all the other cryptocurrencies. Some of you may have seen this before. Some of you may haven't. So this is basically showing you what percentage of the total market cap is due to BTC's market cap. So if we scroll back out a little bit, so back in 2016, we can see that pretty much almost 100% of the total cryptocurrency market cap was due to Bitcoin. I think that's quite obvious. There weren't many other cryptocurrencies around at the time. There were a few others, but they had XRP and Litecoin and Dash and Namecoin, which was an early one. But obviously there weren't many others to compete with it, so it was a majority of the market cap. Then as we get closer to 2018, some of you already know what happened around there. We had the ICO boom, right? So lots of new cryptocurrencies were coming to market. We see BTC dominance fall up from 100% down to a low of 35%. So some of you may have been around in the ICO boom. I certainly was. I was one of those few people that had an ICO as part of my previous company called BAB. And it was absolute mania, right? I think there was over 13 to 1500 coins that were launched in the space of 6 months. And they were all raising crazy amounts of money. All the money that was raised through these ICOs, a lot of it was pulled out of BTC and went into these altcoins. So that's why we saw the altcoins take up a lot of that market cap early on. All the values kind of inflated and dominance came down, obviously, due to that. As many people expected, lots of these ICO companies went bust quite early on. A few of them turned out to be a scam. And as over time, as they go bust and the token value falls, we've seen BTC regain some of that dominance again. So here we can see at the beginning of 2019, it started to regain some up to a recent high of August last year. So approximately a year ago, we saw it break up to 70%. So that's when we saw BTC rally again. Lots of altcoins kind of fall off, either completely fall off the table altogether, or their market cap just come down proportionately, just because they haven't delivered maybe the platform they were promising to deliver didn't actually materialize. That often happened with ICOs. They promised the world, and then in reality they realized this is actually really hard to deliver, if not impossible. So they actually gave up, and that's why all the tokens fell in value. So I just thought it'd be good for you to see the Btc Dominance Chart, just to see how it changes over time and where we are today. So today we're sitting around 60%. So you can see it's come off recently, and a lot of this has been because of Ethereum, right? Some of the other altcoins which have been rallying. We'll get on to why that might have been happening a bit later. Some of you already know that's probably to do with things like DeFi. In the recent run-ups, we've seen Ethereum vastly outperform BTC. And I think that is set to continue, but we'll dive into that a bit later. So now let's jump into Bitcoin. So some of you are crypto traders, some of you are just interested in the market. Here we have the Btc chart, and I've identified just key levels that we should be aware of. So as we all know, we've got this strong level of support down here around $3,000, well-respected level of support. Twice it bounced off there quite strongly, and down here. So we can pretty much rely on that being a steady support level. The famous 10k level, lots of people were debating whether it was going to break 10k. Sometimes it did, sometimes it didn't. And I think this will always continue to be probably now support level. So something we want to look out for in the future, right? So it's just worth putting that on your chart, being aware of it. It's a big whole round number. It's a key level for BTC. So it's definitely an important level to be aware of. We've got the all-time high at the top, just under 20k. It wasn't there for long. I mean, if we actually look at how many days it exceeded 10k during that run-up, so around 99 days, so around 3 months, give or take a little bit here. So it wasn't actually above 10k for that long. If we look at just a recent run-up, the run-up on its own, around 29 days, sorry, 64 days, so 2 months. So it's interesting just to get a bit of proportion as to how long the price actually exceeded a certain level to see how likely it would be to exceed that again. And it took a long while to get above 10k later on. Another key resistance level that we expect to be respected is around 14k. Again, this is where it bounced off that level back in June last year. It's likely to be respected again. That's something to watch out for. And I've just put in here a shaded area of a resistance zone we're in at the moment. So this is a level which we bounced off. We bounced off back around here. So we came up to 20k. We bounced back down to around this level, and it acted as support before eventually breaking lower. It acted as resistance around here. A little bit of resistance around here. It broke through quite violently and came back under. So we can see this level being respected again as a resistance level, which is why I've just highlighted it in there. So it's just good to get an overview from a technical standpoint, what we're looking at from a high level. And this is on the daily chart to see key levels that we want to be aware of when we're trading. From a fundamental viewpoint, BTC has quite a few benefits over other altcoins or other cryptos. The main one being limited supply. Right, as you all know, there's 21 million maximum tokens, coins for BTC, and that will never increase. But there's no inflation built in. It's inflation proof, so to speak. So that's a huge positive for BTC, as well as a network effect. Against all other cryptocurrencies, it's got the greatest network effect, which has a huge value in itself. So some people have been asking, why have we seen this run up in crypto prices recently? So let's look back in April. We were down at, it's hard to believe, isn't it, really? We're down at 4k now, back in March, $4,000, and we're almost 3 times that now in the space of 4 months. So we've had quite a big run up just after that quite aggressive sell-off. Now there's a number of factors at play here, and some of you probably are already aware of them. The most obvious is the unprecedented central bank quantitative easing across the world, which we've all seen, right? All the major economies have had some form of QE, which is devaluing their major currencies and inflating the value of real assets. That's another reason why some people are now coming into BTC and crypto assets, just because they want some safe haven away from inflation, right? So when all the currencies are devaluing because of inflation, having a real hard asset, which is inflation proof, provides a hedge against that. As we've seen in previous periods of instability, when we have QE, we do eventually get inflation, and the assets which do well in these environments are usually gold, silver, real estate, these type of hard assets, right, which generally get inflated when there is inflation. So due to the BTC's finite supply, as we've mentioned, it provides that hedge against those inflationary assets, and now BTC is being seen as this safe haven alongside gold, alongside silver, and real estate. What's more important, and actually which is incredibly surprising to me that not as many people understand this today, is the wealth disparity, which is caused through QE. What I mean by this is when we have a lot of QE, we're getting a huge amount of inflation over time. It doesn't happen immediately. It takes time for inflation to build up. And then what we eventually end up seeing is people who hold real assets, so as I mentioned, stocks and real estate, they see the value of their wealth increase exponentially, right? So if we look over the past 6 months during the COVID crisis, those that have held lots of stocks, lots of real estate, the most wealthy in the economies, in our economy, have absolutely, their wealth has blown out of proportion recently. They've done incredibly well. Now those that don't have those real assets, those that are living paycheck to paycheck, they have a limited amount of cash in their bank account, they're getting the negative sides of inflation. All right, they don't hold any real assets, they don't hold any stocks, they don't hold any real estate. So over time, what they do have in their bank account, the cash, its value is eroding over time. And this is actually making the wealth disparity in all economies far greater than it was prior to QE. And I think now people are starting to realize this, that the actual financial system that we know it has a rigged element, right? This has been made to be built like this. This isn't the byproduct of how it works. It's almost like the system is created to make that wealth disparity worse. And people are starting to realize that now. And that's another reason why we start to see this run up in BTC and crypto, right? It's a way to get out of the existing financial ecosystem, the infrastructure that we already have, and place a bet on a different ecosystem, a different financial system. And that's why I believe we've seen this recent run up in crypto prices. And we've also started to see some large investment funds in the industry now that are allocating to BTC. Some of the large traditional players that perhaps 2-3 years ago were seeing it as a scam are now allocating 1-2% of their funds into BTC. That's a huge level of validation for us, as people in this industry, that it's now finding its space within the global market, the global asset sphere, and its use case, and it really is acting as that hedge against a devaluing currency, and an ecosystem, a financial infrastructure which is not really working for the average Joe or the average person. What I thought would be also interesting, which I've been looking at recently, is how BTC is correlating with silver. So let's just have a look at that. See if we can notice any similarities. So since 2020, we've started, as you can see on the chart, the orange here is silver, and BTC is in the background. So we can see since 2020, there's been a relatively close correlation between the two. Which was quite interesting to see. They're both acting like a safe haven. Silver's, of course, is a lot more volatile than gold. The moves are far more extreme, and of course Bitcoin is a lot more volatile than gold as well. So it's just interesting to note that we are seeing this correlation, and it might be worthwhile keeping an eye on that. It provides some kind of validation that it is being seen as a safe haven asset. Assets are flowing into it in times of distress, as you see with silver. And it'd be interesting to see if that correlation holds over time, to see if it continues to act like this. And maybe now BTC and other crypto assets, Ethereum, are finding their cause and use case for investment managers across the world. That's it for BTC. Now let's go over to Ethereum. Here we have the Ethereum chart. So again, some key levels. We've got a good level of support down here around the 87.90 level. We've got our highest value just underneath $1,400. A strong level of resistance, now potentially support, was around the 360 level. So we can see it acted a strong resistance here. It was support when it came off from its highs. Quite strong support, worked quite well. And it's become resistance since. And potentially support again. So that's a level just to keep an eye out for, 360. If we do see a sell-off back to around those levels, I'd be surprised if we didn't see that act as support. Once Ethereum decides what it wants to do, we'll get an idea of its direction. And of course, here's a similar kind of resistance level that we're seeing with BTC, right? So it's around similar levels. And it's hard to know where we're going yet with Ethereum or BTC, right? We're at some strong levels of resistance. I often like to look at gold to see how things are acting in the gold market, and gold reached a high, I think it's around 2030, 2040, around those levels in dollar terms. It's come off those highs quite considerably now, as the COVID crisis kind of reduced the stress in certain economies over time. So we've seen that pull back, and I think we're seeing a similar little pullback in crypto markets. And again, I'm waiting to see if we're going to see that rally in gold again towards those all-time highs, and whether we'll see a correlation with that in our Ethereum prices and Bitcoin prices. So it's always good just keep an eye on gold and silver when you're looking at crypto markets, to see if they are acting more correlated in certain times than other times. And I guess it makes sense that they would be more correlated now. Again, that re-emphasizes the fact that they are acting like a safe haven in times of distress. Ethereum, I mean, what I like to look at is how far we are from our all-time highs. Of course, Ethereum is far more volatile than BTC, but just to give us some perspective on where we are. So currently around 390. So we're around 252% off our high. All right, that's how much we'd make if it was to go all the way back to our highs. And let's compare that with BTC. So let's remove BTC, let's remove this. So we're about 70% away from all-time high. So from a trading perspective, right, if we're bullish on the market, to me it makes more sense to play that bullish theme out in Ethereum. Now, of course, if you've got other assets in your arsenal that you're looking at, then of course it depends on the fundamentals of those assets and those use cases. But when I look at purely Ethereum and Bitcoin, you know, as a trader, I want volatility. I want the upside. And I see that more in Ethereum. So if you do see those moves back to all-time highs, you know, you potentially would make a 71% gain in BTC. In Ethereum, you know, that's 2.5x. Now, of course, we don't know if they're going to move together in tandem. We've seen Ethereum outperform BTC on those up moves recently. Whether that will continue, we don't know, but that would argue that perhaps we would get to that level maybe sooner in Ethereum if that continues to play out. But that's just a good thing just to pull out, go on your daily time frame or weekly, whatever it is, and get an idea of how far we are away from our all-time high, and if we are to be in a bullish market, you know, what that return might be. Now, some of you know a little bit about Ethereum already. You know, one of the strongest fundamental factors for Ethereum at the moment is DeFi. So for those of you that don't know, DeFi stands for decentralized finance. The idea is that anyone could earn interest on your own funds or borrow funds from other people on a decentralized marketplace, so removing the middleman. So what do I mean by that? For example, when you go to a bank, you can borrow from a bank. The bank is a middleman. They'll take the money from the savers in the bank, and they'll lend that out to you, and they'll make a margin, right? They'll pay the saver maybe 1%. They'll lend it out at 8%, for example, and they'll make the margin. Now, in DeFi, the idea is that we're removing that middleman so that we can put more of those profits back into the pockets of the lender and make borrowing potentially cheaper, right? So we're removing those middlemen from the equation. And of course, that's an exciting thought, right? If we could remove banks and all these other middlemen in all these financial transactions, that means it makes all of us, the individuals, far better off. We can lend at better rates, we can save at better rates. That's great. And if we don't have any intermiddle party that will stop our access to our funds at any point, you know, whether it's a KYC issue or whatever it is, banks have control of your assets. If we can remove that as well, so we have full control over our assets, that's even better. And that's the basic premise behind DeFi. Now, of course, there's lots of iterations of that in DeFi. It's not purely borrowing and lending. There's other things we can do with DeFi, but that's the basic premise. And that's a huge area now, which is growing. The idea is that we'll bring traditional finance onto the blockchain in a decentralized manner. So there's lots of interesting projects which are currently live. I've talked to you about a couple. Some of them you may be aware of already. Compound is one. So this is like a decentralized marketplace. Is it not full screen? I thought it was full screen. Let me have a look, see if I can do that for you. Bear with me. I'm not sure how to do it, if I'm honest, guys. I'm trying to, let me see if I can change this. Desmond, if you've got any idea how to make it full screen, just send me a message and I'll do that. And then meanwhile, I'll carry on. I'll keep an eye on the messages. So here we have Compound. So Compound is a decentralized marketplace, exactly as I just mentioned. There's lots of assets you can deposit and you can earn interest on them. And there's assets you can also borrow. So you can borrow funds, you can deposit some other asset as collateral, borrow an asset against that, and you pay an interest rate on it. So this is generally how it works. And it's purely decentralized. That's the good thing about it, right? There's no middleman. This is a DApp, so decentralized application. There is governance. So I think there is a way that you can vote on changes to the governance, so changes in interest rates, but essentially it's purely decentralized. 1 minute, I'm going to sharing your screen. Let me have a brief look, see if this helps. Okay, is that any better? Or not? Yes, okay, good. Sorry about that. You've had around 20 minutes of seeing a tiny little screen, but never mind. At least it's okay now. Yeah, so that's Compound, which is quite an interesting company. It's been around for a little while. It's purely decentralized and something for you just to have a look at. They've also got their own token, which is a governance token, which is called COMP, C-O-M-P. And the idea is that if you own COMP, you can stake your COMP, which means you can vote on changes to the application. So whether you want to change the reserve amounts required for you to borrow against, so how much capital you have to deposit and what percentage you can borrow against, that's something that the governance could vote on. And there's lots of things that we can vote on to change how it works. So that's an interesting project, something to look at. Let me have a look at what else there is. Synthetics, so synthetics.io is an interesting company. It is more of a company. It is also decentralized. But what they're doing is they're bringing more traditional assets, so stocks, currencies, and they're bringing them onto the blockchain, right? And that's something that's been very difficult to do before. The reason why it's been difficult is because it's been very hard to actually make a blockchain interact with real world data. So how a blockchain can get data from stock, the S&P index or the FTSE 100. It's been quite hard to feed that into the blockchain in an automated fashion. So it's only been, it's been going on a few months, but it's fairly recent change. And that's where Link comes in, and I'll get into Link shortly. But Link helps with that interaction between the blockchain and real world price data or whatever the data may be. So here we can trade gold as a token versus USD. They've got FTSE 100 somewhere down here. They've got silver and other assets. They've got yen, Swiss franc and other assets, which is actually great, right? This removes the barriers for being able to access those assets, and we can access them on a blockchain in a decentralized environment without having to go through, KYC, opening up all the accounts with your broker and all the headache that goes with that. So it's still very early. It's early on in its life cycle, but I'm definitely watching synthetics to see how things develop over time. Another thing which is interesting, some of you may be aware of it, is token sets. So of course I've got a couple of strategies on token sets. Some of you may be aware of that already. We run our ST strategy on here, the non-leveraged one. We do run a core strategy for investors which does go long short and does use leverage, but this is more for retail investors. It's a basic version of that. It has no leverage and it can't short. That's basically because of the limitations of the token sets website. But the good thing about this is it's all decentralized, right? So we can manage funds purely on the blockchain in a transparent way, which is fantastic. So you can always see a track record of an investment manager. You can see what dates and what times they rebalanced. So that's almost like traded, what times they traded between assets, and their trade history of that asset manager is recorded on that blockchain forever, right? So there's no way you can lie about your performance as a fund manager or anything like that. So it's a great innovation industry. As soon as I was aware of the project, I wanted to be a part of that. We've been looking at ways that we can move our strategies onto the blockchain, merely because it is the future of finance and fund management, right? Currently, how fund managers work, it's all behind closed doors. You have to go through the regulatory issues of opening up a fund. Then no one can actually see into that fund, right? It's completely closed off. But the company releases marketing materials on AUM, performance, and things like this. Wouldn't it be far better if all that could be seen by the individual in a transparent way? You wouldn't have to trust the manager on what they're saying. And also, what probably the biggest difference is when you invest in a traditional investment manager, you have to hand over your assets, right? If you want to invest 100k, whatever it is, into a hedge fund, you have to give them the assets, and then they have control over those assets. So if they turn out to be a Bernie Madoff or a scam, they've got your assets and they've run off with them and they're on the Bahamas or on a yacht or whatever it is. But now with token sets, we never have access to these funds. So you can see we're managing around 600k approximately. But I don't hold those assets. So those assets are held on the blockchain, and there's no way I can actually get access to those assets, which is a great innovation. So what happens is when I trade, it will trade their assets on the blockchain, but I can't actually have access to them. and the individual can redeem their investment whenever they want. So if you invested in this fund, you could pull your money out whenever you wanted, and that's it. There's no caps or 6-month minimum terms. It's completely flexible and easy. And this is where I see the investment management industry going. I mean, it just makes far more sense. So really happy to be a part of them. It's a great company. Check them out if you can. They've got lots of cool strategies on there, lots of different businesses. It's definitely worth checking out. And this is one other thing that I think is worth mentioning. This is trading futures now on the blockchain, so similar to token sets, but these assets are on the blockchain. So our core strategy is on Binance Futures, right? That's where we trade on behalf of our investors, but that's a centralized system. This is a next level of that. It's called DYDX, and this is the next iteration where you can still trade leveraged futures, but it's all decentralized on a blockchain. That's another interesting project. I thought it might be worth mentioning. Could be interesting to some of you that are keen to find out more about the industry. And these are some of the reasons why Ethereum has been doing so well recently, right? These are all built on the Ethereum protocol. All these businesses which are revenue generating, they've got interesting use cases, they're being used, they've got lots of volume. They're all built on top of Ethereum, and that's I think that's great for the industry, and Ethereum in itself. So that's something BTC doesn't have, right? BTC is a mere payment protocol, but they're not able to build on top of that as a platform, so to speak. Just to check, can you all see the screen okay and hear me okay? Great, good. Okay, now over to Link. So some of you may be aware of Link, some of you may be new to it, but Link is a really interesting project, and if you just look at that price, it's just been astronomical recently. So what does Link do? Link provides something what's referred to as an oracle on the blockchain, and that's what I referred to earlier. So an oracle is something that lets the blockchain interact with real world data, whether that's the FTSE 100 price on a daily basis, or I don't know, the weather in California, whatever it might be. It's a way that it can interact with blockchains, and we can build that data into a smart contract to make it act automatically based on the data it's receiving. And that's essentially what Link does, and it does it well. So lots of those projects I've just referred to use Link as their oracle. So TokenSet certainly does. It uses Link to get price data onto the blockchain, and we use that when we trade. So if you look at the price here, the move's just been insane, and we do have a strategy that trades Link. It's on token sets. We trade it versus Ethereum, so it's a pure 100% cryptocurrency based strategy, which means if we see a huge sell-off in the crypto markets, you're going to lose your USD value. But the idea is that over time you start to stack Ether, right? So we trade it versus Link. Over time we want to accumulate more Ether over time, regardless of the USD value of Link or Ether. And that's something that lots of people in the crypto space want. They want more Ether. They don't care about the USD value because they know long term it's going up, it's going higher. So they just want more. And this is what the strategy does. So look, if you look at the moves, as percentage wise, so back in the 7th of July, so what's that, just under 2 months ago, to its all-time high, for almost 300%, which is of course a huge move. To where we are now, it's around 200%. And it's a small project, and it has a huge valuation. I think it's around 2.5-3 billion. It may be more than that now actually, which you could argue is probably a little overinflated considering how early we are in the ecosystem. It does have some use cases already. As I mentioned, there are some businesses using it, but it's still got a long way to prove itself. So if you are trading any of these smaller tokens such as Link, or Comp, or anything really which isn't Ethereum, Bitcoin, just be a little bit careful because they're usually a lot more volatile, right? The moves are far more aggressive. Therefore, you want to reduce your risk down proportionately. If you can see here, the moves can be relatively strong, and it's something to be aware of. So Link is just an interesting asset which I'm watching. I trade it, and yeah, it has a good fit for the growth of DeFi and the ecosystem. Now, something to be aware of with DeFi is, it's still relatively early. We had the ICO boom a few years ago. That all fizzled out. And some people are saying, are we going to see a similar thing with DeFi? Like, is DeFi just a thing that's around now because it's cool and it's interesting and people are going to make some money and it's going to fizzle out? Lots of people are thinking that. My personal opinion is I don't think that's the case. I think DeFi makes complete sense to decentralize finance, to move away from banks, those other institutions which take a huge amount of those profit margins at the expense of the users, the individuals. So from a theory basis, it makes total sense to me. But then again, we don't know which of the projects are going to make it the long term, and that's something to be aware of, right? We don't know if Link is going to be the go-to oracle for the blockchain. We don't know if Compound is going to be the go-to decentralized marketplace for savings and loans. So if you are trading any of these tokens or you're holding some of them, again, just bear that in mind. There's likely to be lots of losers before we find those long-term winners. But that's just an overview of DeFi. I may do something a bit more interesting in DeFi in maybe a focused webinar if there is interest in that. But I just wanted to give you some overview on why we think Ethereum is having such an aggressive move relative to BTC, largely driven because of the buzz around DeFi at the moment. That's it for Link. Now I thought finally we'll talk about the blockchain, the actual blockchain itself. Now we use blockchain data in one of our new strategies we're developing. So what do I mean by blockchain data? So of course all blockchains are, or not all of them, majority of them are transparent, which means you can go to a browser for Ethereum, you can go to etherscan.io and you can literally look at the blockchain. You can see what transactions are happening at that moment. You can see the size of those transactions, how many in a given minute, and it's all transparent for you to see. You obviously can't see the identity of the people sending the transactions because, of course, that's not shown, just the actual numbers of the address. But what we've realized over time and from our own internal research is that we can use this data to actually form strategies, if not wholly strategies themselves, but signals that may help with our strategy, whether it means give us indications as when to increase leverage or when to reduce leverage or stop out. We've learned that actually we can use these quite in a smart way to help with strategies. The basic idea behind that is by looking at the blockchain, we can get an idea of activity. And the general theme is the more activity on the blockchain, the higher the price. Now, of course, that's very basic, but that's the general idea on how we can use it. So we look at things like, let's go to Ethereum. I'm mainly focused on Ethereum, not so much on BTC. So I look at things like new addresses and active addresses, which have actually proved to be great indications of price. So over time, as we see increases in the number of new addresses, that's on the bottom down here, we like to see an increase in price. Now, of course, that's not always the case. It's not a perfect signal that we can use, but more often than not, it does help. Now, the question is, what kind of moving averages do you want to use on that data? I mean, look how noisy this data is. It's extremely noisy, and this is just daily data, so you can actually get hourly data, which is almost unusable. So the question is, what kind of moving average would you want to use in it, just to kind of iron out the volatility in the data itself. But you know, we can see a relatively good correlation here, and sometimes we can see that actually number of addresses is a leading indicator. Right, look here, we've seen the run up and we're seeing the highs and the prices, and we see the data come off. So we see number of addresses fall off a cliff just before price starts to come off. And it is a fairly strong correlation here. We see a big run up in new addresses before we see the run up in price, and we see the sell off just before as well. Now it's not always as clear as that. So what we've done is we put a number of trend following models on 5, maybe I think 6 in total data sets we have, which may include addresses, the things such as gas fees, how gas fees change over time, and this is an interesting area which is just growing, which not many people know about. But we can look into and get good insights into what's happening on the blockchain, what activity is happening, and what can we understand might happen to price based on that change in activity. So it's a relative change in activity over time that we're interested in. So let's look at what other metrics there are to look at. We've got addresses here, as we've mentioned. There are exchanges, so we get some data from exchanges, so we can actually see the flows, how the change in flow happens in and out of exchanges. So when there's a period of a lot of inflow into an exchange, you might think, well, perhaps people are putting their cash or their assets into the exchange to sell it, right? That seems logical. And when you see an outflow, a huge outflow of assets from exchanges, you could say, okay, maybe people have bought on exchange and now they were looking to store in a hard wallet. They want to put it into safekeeping, which could be a bullish signal. So we look at some of these fundamental reasonings and logical reasonings as to why we see the change in data and try to build them into strategies. So that's a good one as well. So the website's called Glassnode. You can have a look around it in your own time. There's some really interesting data we can look at there. Let's see what else there is. Fees. So as some of you may or may not know, the fees on the Ethereum blockchain have been astronomical recently. They've been almost unbearable. When we rebalance our trades on our strategies, on one of our strategies, we paid over $400 just for a trade. That's just to rebalance. Previously, they were like $20, $30. Now, that's because there's lots of transactions happening on the Ethereum blockchain, which has pushed the gas price up so much, which is making the fees quite expensive. So that's something that we can actually determine. Well, if there's lots of activity on the blockchain, fees are higher, perhaps that means that price is also going up, because to pay for those fees, you need Ethereum, right? So if fees are higher, you might need to buy more Ethereum to pay for those fees. And that's another thing that you could look into. Gas used or fees are interesting to look at. Let's see if there's one more thing that we can look at here that might be interesting. Transactions. Yes, this is another good one. So transaction count. So we can see how transactions change over time. So the number of transactions in any given time period, whether that's hourly, daily, if we see the number of transactions increase in a given time period, again, that could be a bullish indicator to price. And that's how we look at transaction count. Quite similar to transaction rate and transfer count and transfer rate. So what I'm going to do at some point is I'll do a dedicated webinar on blockchain data and maybe look into more detail how we can read different elements of the data and what may infer about price. But that's pretty much it for today's webinar. I hope just a brief overview of the market, some interesting developments, of course, blockchain data and DeFi. But do you guys have any questions before we finish up? If you want to type them into the chat, happy to answer them. Just while I'm waiting for the questions, in the meantime, I remember Patrick asked a question about if he has a long-only portfolio and he's looking to add some altcoins in, what would he look to add? Again, it's a very difficult question. As I've said before, there's lots of interesting projects in DeFi now which are doing quite well, such as Link, but that doesn't necessarily mean over the longer term they're also going to be that good or perform as well. So, you know, my only two long-term holds are Bitcoin and Ethereum. They're the only two assets that I believe in long-term from their fundamental use cases, both very different to each other, and they're the only two I'd hold for long-term. So if you are looking to add some altcoins to your basket, just be very aware. Of course, understand the fundamentals. What's the use case of them? Can you foresee that being a use case in the future? You'd analyze it like any other stock, right? You look at the stock. What does the company do? Is the company likely to be around in the long term? Is it adaptable to changes? I mean, the crypto ecosystem changes almost month to month with new developments. Is that the type of business that it will be around for the longer term? And have some of those interesting thoughts that you might have if you're investing in a stock or a penny stock or something like that. But personal opinion, I just stick with Ethereum and Btc long-term holds. They are all I can withstand from a risk perspective, considering the drawdowns. Some of those altcoins get more aggressive than those. So yeah, it's a bit difficult on the altcoin side. Just make sure you do your due diligence and don't just buy into the hype, which lots of people seem to do and then get stung. Okay, question from Rafat. I have used some risk management for alts, which looks useful, and that's great to hear. What kind of risk management have you used? If you could just maybe explain, it'll be interesting to understand a bit more how that works, because they are quite volatile. And generally when you see a sell-off, you're getting a sell-off across the board, right? So do you convert to cash? Do you convert to Ethereum, to BTC? There's something you want to bear in mind. But altcoins, yeah, there's lots of good moves in them that perhaps you could ride over longer term.
I can explain like what my ideology is, my thought process.
Yes, go ahead.
Well, basically, I've been for quite some time that most cryptocurrencies are getting supported by the 20-week moving average. So you may develop a strategy basically that is counting the percentage of the price going above the 20-week moving average of specific asset,
Mm-hmm.
and then use this percentage as a risk measurement. So for example, what I'm doing basically is, say at the moment Btc is around just 1 second. Yeah. So Btc is around 11.4k,
Mm-hmm.
and this would make it 0.47 risk measurement. And for example, for Link, that would be 0.75 at the moment on this specific price. And you can basically use this. It's a simple mathematical formula. You can use it to measure, for example, how much risk you would have if the Link price is going to be, let's say, $24. So that is very useful, and what I'm doing is basically whenever I see the risk of a specific asset, let's say Link, goes above 0.5 or 0.6, something like that, depends on the asset, I'm just converting the profits in Btc or any other asset that is below 0.5 risk.
Okay, I think that makes sense. So it's almost like a portfolio management, risk management, where you have set allocations, and when they get out of whack, you want to rebalance to those allocations. Is that right?
Yeah, exactly.
Okay, that's interesting. So what happens when you get a sell-off in the
Well,
industry?
the whole point is that this indicator, let's say it, uses, it's dynamic basically, it's not static. So it takes the price, which is taken into consideration from the 20-week moving average. So whenever there is a new week, you have a new risk point, if that makes sense. So it gives you levels. I have like 20 levels or so on different price tags, which with which I measure like the risk. For example, if let's say Link chain goes to $7, it's going to be a 0.52 risk at the moment with the moving average right now. And if it goes to $22, it's going to be 0.89. So if we have a spike, it's going to be taken into consideration. Maybe not going to like catch the spike. You will be most probably affected by it, but not so much.
Interesting. Yeah, I mean, there's lots of methods that can work. It's of course they're volatile assets to trade. We as a fund don't really allocate any funds to them just purely because of the risk perspective. But if you've got a method that seems to work from a risk management perspective by having those common allocations to those assets and banking profits on the run-ups and you can mitigate some of your downside, then that's great. That can be used. On Binance Futures now, there's lots of assets you can trade for your crypto traders. I think there's around 30 assets or so that you can trade with leverage. So of course, trade with care on those markets. But that's great that you can trade those and you've got your own risk management rules. That's good to hear. Okay, Callum, so question, how far do you think Link will retrace from this recent run-up? Well, if I knew that, that would make life easy, wouldn't it? That would be great. So the question is it going to retrace? Right, so I don't know if it's obvious, personally. What I look at is I'll pull up another chart that we use in our strategy. So this is Link versus Ether. So if the idea is that we're going to get another run up in crypto prices, then I think it's reasonable to see Link rally again. I think we've just seen that happen. But here, this is Ether versus Link, or the other way around. So this is part of the strategy. We're trying to trade them versus each other. I think if we're looking purely on a USD value, you know, you've got a level of potential support down here at $8, and I think I did I write this into one of the groups earlier? I can't remember. But there's a level of support around here, and potentially another one up here. It's really hard to say what's going to happen with Link, and that's why when we trade it, we trade it with caution, right? You know, look how quickly this move can happen. These two moves in the space of, 3 or 4 days. So I think we could even see another run up higher. Otherwise, we've got a level of support which could be acted around, just under $9. Or there's even further support down here around 4.8. But it's really difficult to say. We look at this chart, which is, as I said, Link versus Ethereum. We're waiting to see Link retrace further versus Ethereum. So that will happen if we get a pullback in Link in USD value, or we get a rally in Ethereum in USD value. When one of those two happens, we'll get this retrace back down towards the bottom of the Bollinger Band, and we may look at re-entering our token set strategy. But yeah, it's a really hard question regarding Link, and it's something I trade with caution. Next question, how much do you look at major macro markets as an indicator for crypto? If volatility increases in the stock market leading into next US presidential election and we see a pullback, likely to have a similar effect on crypto like in March? That is a good question. Yeah, I think it's really important, especially now more than ever in the crypto ecosystem, to be aware of the macro environment, what is happening on a macro level. What March has shown us is that all these markets are linked, right? Crypto is not this separate market which has its own life and completely removed from traditional markets. It is related because now we have institutional investors, funds that are allocating in this space. So if they're allocating in this space and they see a sell-off in the market, they're going to liquidate their positions, their risk across all levels. They're not going to liquidate all their stocks, bonds and everything else and leave their BTC exposure. They're going to liquidate everything. And what that means is it's made the whole global markets correlate because of that, because of the participants and how they act. So yeah, I think if we do see a volatility in the stock market leading up to the election, I guess it would depend on what side we'll be looking at. But yeah, we need to keep an eye on crypto and to see how it reacts. What I look at more importantly than maybe the stock market is gold and silver, as I mentioned earlier on. Gold and silver, the correlations, they're not identical, but they seem to be getting stronger and stronger over time. And again, that is part to do with who's acting in these markets, the fund managers, how they manage risk, how they perceive the BTC asset in their portfolio. If they perceive it a certain way, they're going to act on it a certain way, and it's going to be self-reinforcing. So definitely keep an eye on gold and silver. As I showed you earlier on, silver seems to have a relatively high correlation to BTC at the moment, and interesting to see if that continues. And always be aware of the market, the global dynamics and what's happening, especially in the US, right? The US is the biggest market, mainly for crypto, has the most number of participants in there. So it's always good to keep abreast of what's going on from central banks. QE obviously is the biggest impact on crypto markets. That's a bullish thing for crypto markets. If we see continued QE and further QE, then of course we're going to see hopefully further upside in crypto. That's my play, a long-term vision. I don't see how we can be in an environment where central banks can pull QE from the markets. I don't see how that can happen anymore, to be honest. I wouldn't be surprised if we see QE for the rest of time. I don't know how it can be removed, but either way, further QE should be bullish for crypto prices. So yes, definitely keep an eye on the global markets. Okay, guys, thank you for the time. And sorry that the first 20 minutes or so were tiny. Apologies for that. But I hope that was insightful. Have a great weekend, and I look forward to presenting you next time on blockchain data and how we can infer changes in price from that. Have a good one, guys, and I'll speak to you next time. Thanks a lot.